Hello again. Welcome to another episode of the Uranium Market Minute. Today is Tuesday, March 1st, and this is episode number 85. My name is Justin Hune. I'm your host. I'm the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you again for tuning in. Really appreciate you being here. Before we get into it, as always, nothing in this video is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own choices. All right, this is going to be a really fast episode. I am knee deep in working on the newsletter, which will go out tomorrow morning prior to the open of the markets. This is our March newsletter. It's probably going to be somewhere around 30 pages. We'll go really in depth into what's going on with the reverse carry trade. Obviously, what's happening to the extent that we can understand it in Russia and the Ukraine, and of course, its implications on the nuclear fuel markets and what we're seeing in those markets. So if you remember, look out for that. That will be uploaded and downloadable tomorrow morning before the open. We will send out an email bulletin letting you know that it has been published. If you're not a member and you're interested in seeing our content, click the link in the description below and you will get a free sample of a previous month's newsletter, get an idea of the type of content that we put out. On that note, I'm going to run through the daily scoreboard really quickly here. We'll look at the charts briefly, and then I'm going to talk about something we call the flywheel effect ×2 in the mailbag section. So stay tuned. Here we go. Scoreboard, daily scoreboard here. Spot price of uranium up over $1 again today, $49.50 mid-market. We are getting close to that elusive $50 threshold that we broke through for a couple of days back in September. It's looking practically inevitable that we will punch through that, if not today, probably this week, and the uranium market continues to surge. Yesterday, the Sprott Physical Uranium Trust raised another $38 million in new capital and purchased another 600,000 pounds of U3O8. Just absolutely incredible numbers coming from Sprott. Year to date, they purchased 6.8 million pounds and 389.4 million of new capital has been raised. If you annualize those numbers, I'm not going to annualize the capital raised here, but those pounds purchases, we're looking at more than 40 million pounds if they keep up this pace year to date throughout the year. Like I said, we're not betting on that, but we would not be surprised to see them hit that number this year. Of course, like I mentioned previously, we have modeled out for 25 million pounds in purchasing from Sprott, and we think that they're going to vastly overshoot that. Yesterday, they did close, however, at a slight discount to NAV, minus 0.31%. The trust is trading up over 1.5% last time I checked. Though the spot price is up, they're right on that threshold being able to raise capital. As we've seen the past few weeks, if they're above that 1% premium to NAV for 5 minutes, they are in there issuing shares in that ATM. So their treasury sits at 90.7 million in cash, which means they have about 60 million for purchasing. Let's see if they did a little bit more buying today. We will know in the next few hours. Turning to the ETFs, both URA and URNM reported very large new share issuances. Okay, URA increased in outstanding shares 780,000 new shares. URNM issued a very large one-day increase of 350,000 new shares. That gave rise to 39.2 million in new mandated buying. I'm going to discuss the implications of this in the mailbag section. The two ETFs, of course, again, are at an all-time high in terms of combined outstanding share counts, and the AUMs combined is just under 2.2 billion. Very big moves this year so far in the ETFs. Yesterday's trading action was very strong across the sector. Today, we saw a little bit of a dip, a little bit of some profit taking. However, the sector is clawing back and is mostly in the green today. Some stocks are actually up quite large today in the uranium space, despite the S&P being down over 1%. Weak tape across the broad markets and outperformance again in the uranium sector, which is just absolutely wonderful to see. On that note, let's go ahead and take a look at the charts. As I mentioned, looking at the S&P here first, down 1.53% on the day. Definitely some weak tape across the broad markets. URA slightly down on the day. We did see some dip buying come in. It was green about 10 minutes ago. We'll see if we can close in the green, which obviously would be a good sign. Naturally, we'll see profit taking in sectors that have big moves over the course of a few days. And of course, that's always what we see in any type of bull market is there's profit taking along the way. Either way, it did trade up quite high today. Likely we'll see another increase in outstanding shares going into tomorrow. Sprott Physical Uranium Trust, very, very strong here, up 2.5%. So they're definitely in that 1% premium to NAV range today, despite the fact that the spot price is up slightly as well. So they're probably in the market issuing shares, raising some more cash today. Just a beautiful, beautiful chart. Not much reversal in terms of profit taking on that breakout. Very, very happy to see that. And of course, we're pretty close in line with NAV in terms of the present spot price, which is pushing $50 a pound. And we can see we vastly overshot NAV back in September when we were at, I think, a high print of 52 on the ask, which was back, let's see, second week of September, but we were close to a 15 plus, maybe even close to a 20% premium to NAV for a day or two in mid-September. Not seeing that here, but of course, this is an absolutely gorgeous chart. We have these 50-day and 20-day just sandwiched and moving up. This big, beautiful triangle breakout, just huge, absolutely huge. Let's look at Cameco really quick. Cameco also quite strong, barely down on the day after 3 really big days. Again, I noted yesterday the concentration of the moving averages that are all stacked up on top of each other and all moving up sharply, indicators moving into positive territory. Very nice to see across the sector. We even have potentially a little bit of a reverse head and shoulders here, which obviously is a very strong pattern. All right, mailbag section. So I want to talk about something, a concept that we've talked about many times in the past. We've been highlighting this over the past year and a half, really, in the newsletter, is this concept we call the flywheel effect. And essentially what a flywheel is in an automobile is it's a mechanism that allows the momentum of the spinning of an axle to kind of create its own momentum and carry on the ability for the vehicle to coast and move more efficiently, let's say. So the movement begets movement is really what the concept is about. And in terms of the ETFs, what the flywheel effect essentially is that when flows go into the ETF, so when large institutions or heavy retail buying is purchasing shares of the ETFs, that of course causes those ETFs to issue shares and to buy their underlying holdings, which is buying pressure across the sector. And as we've seen multiple times over the past year and a half or so since the sector really broke out, is that in times of heavy ETF flows, the underlying holdings can vastly outperform. And the reason for that is has to do with not only less liquidity, but a tighter share structure. So especially the stocks that have tight share structures in terms of limited float, free float of their outstanding shares. So if you have a company that has a large institutional ownership, large insider ownership, potentially there's another company that owns a large percentage of their shares, et cetera, et cetera. The amount of shares left over that aren't free trading necessarily is really what's available in the open market. And to the extent that a smaller percentage of a company's outstanding shares are free floating leads to larger moves, both to the upside and the downside. This, of course, also affects the valuation of these companies, which is why I've stated, in multiple market minutes and multiple interviews that I've done and multiple newsletters, is that the way that the stocks move in this space, it's all about flows. It's not about necessarily, forward cash flow analysis. It's not about the expectation of production and the cash flow that the company may or may not be producing in X number of years at X price of uranium. Now, that's not to say that that type of analysis is not important or valuable at all. But in this space, you're going to have 95% of the companies never produce a single dollar of cash flow, yet you're going to see these companies go into valuations into the hundreds of millions, if not billions, even for non-producing companies. And why is that? That's because there's less than 70 companies in the entire space. And when money flows into this space, it's like, it's like the Hoover Dam going through a drinking straw. If I recall correctly, that came from either Rick Rule or Doug Casey. So it's when funds try to flow into a tiny space, it's like, a concert hall trying to panic exit out of a single exit door. It really creates massive moves in the sector. And a lot of that is driven by ETF flows. So now that we're seeing the sector turn bullish again, we're seeing the sector turn green, we're seeing volumes increase again. The ETF flows are are drastically attributing to the moves across the sector. This is why we pay less attention to actual valuation and more attention to share structure, jurisdiction, management, and ETF flows. Those ETF flows are huge. So what is the flywheel effect times two? Flywheel effect times two is the emergence of SPUT and the emergence of a vehicle that is highly liquid, that issues shares on an ATM at the market financing vehicle, that purchases physical uranium and is a relatively consistent bid in the spot market. Now, this vehicle is also a significant holding in both ETFs. So what we have is when money flows into these ETFs, and why does money flow into the ETFs? Well, for retail, it's a shotgun approach. It's a way to add lower risk exposure to a sector without having to really do a lot of research or any research at all, really, on underlying companies to pick and choose the companies that you hold. Of course, that's what we do because we have a process of finding the companies that we feel have the greatest upside potential in this bull market and will outperform the ETFs. And we did do just that last year. We outperformed the ETFs significantly. So for retail, that's the purpose of the ETFs. Once you get into larger, higher net worth retail and institutional, it's all about liquidity. So it's exposure, of course, to the sector, and exposure to the miners, which have greater volatility to the upside and the downside of the physical metal, but it's all about liquidity. So institutions go for liquidity. When you're managing tens, if not hundreds of millions, potentially billions, or in some cases, even trillions, liquidity is paramount, okay? Paramount. And so when money flows into the ETFs, not only do they buy their underlying holdings, which is Flywheel one of their holdings is SPUT. So ETF flows lead to buying a SPUT, lead to buying a physical. So these ETF flows are actually leading to physical pounds purchased in the spot market, which of course leads to pressure on the spot market, leads to accretive moves in the spot price, which leads to the underlying holdings also catching a bid. When the spot price is moving up, people come into the sector, they buy the equities. That's just kind of how it works, generally speaking. So that's that double flywheel. It's the ETF flows are not only buying the other underlying holdings, but they're also buying physical via, by proxy, via SPUT. So that's that double flywheel, and that's what we're seeing, and that's what we're going to continue to see if the flows continue to move into this market. I'm going to leave it at that for today. There's so much more to talk about. I'm just going to briefly mention that the analysis companies, the consultants, nuclear fuel consultants, UXC and Trade Tech are the two prominent ones. They're starting to sound the alarm, let's say. That's to basically tell the utilities that that you should really have your eye on long-term implications of this situation and make sure that you're vigilant about being covered out into the future. That's essentially what they're saying. I can't quote them. It's behind a paywall. But these are entities that have been, well, especially UXC. Trade Tech, I think, has been more bullish. Bullish is not really the right word coming from a consultancy company, but more positive on the expectation of an accretive price movement in the spot price and term price, midterm price, and all elements of the fuel cycle. And they have been for years. They've been seeing the writing on the wall. UXC has been a little bit more tepid. That's changed over the past year and a half or so. And finally, we're seeing language coming from them that is, it's not alarmist, but it's a little bit more honest in terms of signaling to the utilities that if you are uncovered, that you might need to take care of business and do it soon, and take heed of the risks that are on the table now that weren't there even a short time ago. So that's something I just wanted to mention. As I mentioned, tomorrow's newsletter will come out before the open. So if you are a member, look out for that. And I will see you all tomorrow. Take care. Be well. Cheers.